Welcome to Iraqi Dinar Update, your go-to source for the latest news, expert insights, and real-time developments on Iraq's currency, economy, and financial reforms. Whether you're a long-time investor or just curious about the dinar, you're in the right place. When discussing topics as complex and sensitive as national currency reforms, especially those that may involve a potential revaluation, it's important to understand that there are layers of strategic silence involved. One of the most closely guarded elements in such a monetary transition is the potential new exchange rate. It's something that, no matter how deeply one investigates or how close one gets to central bank officials, finance ministry insiders, or international financial institutions like the IMF or World Bank, will never be explicitly revealed before the appropriate time. This isn't because the officials are attempting to be evasive for the sake of secrecy alone, nor is it a reflection of any kind of deception. Instead, the silence surrounding the exact figure of a future exchange rate is a calculated and necessary measure to protect the integrity of the broader monetary reform process. To illustrate why such information must be withheld, consider the profound market implications if a revaluation rate were prematurely disclosed. Currency markets, investment flows, sovereign debt ratings, and even trade relationships could all be destabilized by early speculation or manipulation. If the world were to find out, even inadvertently, what a country's new currency rate might be, speculators could rush in and exploit the situation, creating both economic and political chaos. The sudden inflow of speculative capital could overwhelm domestic financial institutions. Moreover, citizens of the country in question might behave unpredictably, some liquidating assets, others hoarding cash or foreign currencies, or altering their normal patterns of consumption and investment. In this context, releasing a new exchange rate prematurely could act like a financial earthquake, shaking the entire economic structure to its core. This is why central banks, ministries of finance, and monetary policy committees tread carefully. Their language is often precise, deliberate, and constrained. While they may publish broad policy outlines, issue progress reports on financial digitization, or reference alignment with international accounting standards, they will never utter the actual numbers that many observers are desperate to hear. It's not because they lack those numbers. In most cases, if a currency revaluation is genuinely in the works, a range of potential exchange rate targets has already been analyzed behind closed doors through highly detailed econometric models. These projections take into account macroeconomic indicators such as inflation, GDP growth, foreign currency reserves, current account balances, and purchasing power parity. But those numbers are for internal planning, not public release. This educational process also serves another purpose. It reduces the likelihood of emotional, reactive behavior from the public. If individuals can see the logic behind monetary reforms, they are more likely to trust the system, more likely to wait instead of acting in haste. Currency reforms are delicate not only because of their technical complexity, but also because of their psychological dimension. Money, after all, is not just a medium of exchange. It's a social contract. Its value is derived from collective trust. Erode that trust, and even the best-designed currency policy will fail. Build that trust, however, through a series of the authorities also face another set of challenges, external actors. The international financial community is always watching, and its response to a country's reform plans can heavily influence outcomes. A premature leak of revaluation figures might not just cause domestic panic, it could also attract unwanted scrutiny from large global banks, hedge funds, or even rival governments. Markets move based on expectations, and those expectations are shaped by headlines, insider whispers, and market forecasts. If a new exchange rate is even rumored, billions of dollars can move in or out of a country in mere hours. That kind of volatility is precisely what policymakers aim to avoid. They are not just protecting the public from instability, they are protecting the nation's economy from speculative warfare. Yet amid this necessary silence, the narrative continues to unfold. Each official meeting between central bankers and international partners, each digital payment pilot project, each mention of WTO accession or currency swap agreement with a major trading partner, these are all puzzle pieces. They hint at alignment. They suggest confidence. They show that the country is moving in step with international norms. This is the education the original statement referred to. It's not an open book exam. It's a slow reveal. A nation must demonstrate that it is earning its seat at the table, not just by declaring a new currency value, but by proving its economic resilience, its policy maturity, and its financial transparency over time. This is why even major announcements, like launching a digital currency, banning street-level money changes, or requiring banks to settle trade in local currency, are often presented as reforms rather than steps toward a revaluation. They are both. But the public face of these reforms is always more restrained. Officials talk about modernization, banking confidence, price stability. But underneath the surface, they are building the scaffolding for a monetary structure that could support a stronger, more internationally recognized currency. In this way, revaluation becomes a strategic culmination rather than a speculative surprise. And when it finally does occur, if it is ever officially declared, it will likely be sudden, coordinated, and presented as the natural next step in a long and steady path of reform. It won't be the result of pressure from investors or rumors on social media. It will be the outcome of disciplined financial management, successful economic integration, and trust built patiently over years. For those who are following the process closely, it's important to learn how to read the signs. If you expect a flashing neon sign that says revaluation coming soon, you will be disappointed. But if you understand that reform announcements, shifts in monetary policy, digitization of financial services, and new trade frameworks are all proxies for deeper structural change, then you can begin to see the trajectory clearly. So yes, one of the things they will never tell you is the exact exchange rate. That number is far too powerful to release casually. It carries with it the weight of economic transformation, political accountability, and financial speculation. Revealing it prematurely could wreck years of planning. But what they will do is prepare you. They'll guide you through educational programs, technical reforms, regulatory updates, and international dialogues. And if you pay attention, you'll see that the story is not one of silence, but of deliberate, disciplined communication. It's a narrative not of withholding, but of preparation. And in the end, that preparation might be the strongest signal of all. Thanks for tuning in to Iraqi Dinar Update. If you found this content helpful, be sure to like, subscribe, and hit the notification bell so you never miss a beat on Iraq's evolving financial landscape. Stay informed and stay ready.